So far, we've covered two types of investing. Active investing, generating market return through stock selection and market timing, commonly referred to as generating alpha in the market. On the other hand, there's passive investing, simply capturing market return, referred to as beta, at a much more cost-effective level. But there is a third way, a halfway house, known as factor investing.
Sometimes referred to as a smart, strategic, or alternative beta, factor investing is based on the multi-factor model developed by two American academics, the Nobel laureate Eugene Fama and his colleague Kenneth French.
The multi-factor model took the equity returns of stocks and carved them up into slices, basically looking at the size of the companies and a value growth metric. And so by dividing up the market into these slices and looking at the returns of these different slices, academics, and primarily Fama and French, uncovered that there had been higher returns among small companies and among value companies. And then when you blended that, you even had a combination of these factors for even higher returns.
Eric Shabini of the prestigious French business school EDIC and their index venture Scientific Beta explains further.
Factors are just a simple way to group stocks together by a common characteristic. So for example, the value factor is a grouping of stocks with a low valuation ratio into a single portfolio. The valuation ratio in this case would be represented by the stock's price to book ratio. Now, what is interesting about these factor portfolios is that their stocks are exposed to a common kind of risk, a risk that is well rewarded, better rewarded than a market index.
Factor investing has received significant attention over recent years. A few hundred factors have been researched. So how does one approach factor investing when there's just so much choice?
Here, we turn to the academic evidence. It takes a long time to establish a consensus that a risk factor will be well rewarded. This evidence is often based on a long-term analysis of equity markets that stretches back 60 to 80 years. This empirical analysis is not just conducted in one market, but across all international markets, including emerging markets. In equity markets, there are only a handful of factors that expose investors to certain kinds of risks that are well rewarded. These factors are value, momentum, size, low volatility, high profitability, and lower investment.
So are factor strategies a good idea? Factor-based funds are slightly more expensive than conventional passive funds, but if you're willing to be patient, then yes, they can make sense. What you must remember about these different factors is that whilst they are expected to generate higher returns, there is a price to pay in the form of greater risk.
Many investors are too impatient. They expect outperformance far more quickly than is reasonable.
All of the factors, consensual factors, are rewarded over long periods of time. However, what investors often misconstrue is that in the short term, these factors should be rewarded. And so they lack the patience to hold the factors through their cycle.
But what is important to bear in mind is that the reward to these risk factors doesn't come every day, every week, or even every year. Investors have to be very patient to benefit from the rewards to these types of factor portfolios. Often, they have to wait for a whole economic cycle.
Some have questioned whether factors are as applicable in smaller markets like South Africa.
Factors isn't something new to the South African market. We've seen that the active managers have typically branded themselves as value managers or quality managers. We just now have the index version of those available to the market.
The evidence that we've looked at in the South African market would suggest that factors do indeed have the same application in our local market as they do abroad and in global markets. However, investors should be cognizant of the fact that in our local market being more concentrated and less diverse, there may be single stock or sector idiosyncratic risk that relates to factor-based investing in our markets.
The issue of cyclicality and sector concentration has largely been addressed through the creation of one strategy which holds all the factors, known as multi-factor.
Multi-factor approach to investing looks at harnessing all of the factors simultaneously. And what this means for an investor is that rather than being exposed to one factor and in turn potentially to one sector or to one share, we diversify across the factors and then of course in turn to the sectors and individual shares. So we get a more diversified outcome in our local markets.
It's also important to bear in mind that since a single factor portfolio can suffer underperformance for a prolonged period of time, investors benefit from investing in a number of different factors to smooth out performance over time.
So when deciding how to invest, the most important thing is to avoid high-cost, actively managed funds, certainly when investing in equities. The evidence clearly shows that the best approach is a combination of passive and factor investing, both important parts of an evidence-based investing approach.
By choosing this route, you're far more likely to have a successful experience in investing.